Hello everyone, welcome to today's US Open live webinar. It is Thursday, May the 4th, 10 minutes before Wall Street opens. As always, I'm your host, Nikos Zabouras, Senior Market Specialist at FXCM. As we already said on Tuesday, this is a very busy week, and of course, dominated by the Fed, which raised rates on Wednesday, but opened the door to a pause, without, however, taking off more tightening completely off the table. Meanwhile, banking fears persist, while the ECB today, the European Central Bank, slowed the pace of tightening with a 25 basis points increase. And before we go into all of that, as always, please read carefully the risk warning and the disclaimers. Once again, please go carefully over the risk warning and the disclaimers. And also please note that anything discussed today is not, and on these sessions, does not constitute investment advice and should not be taken as such. Okay, let's get the ball rolling. As I already mentioned, this is a very busy week with many data points, developments, earnings, many things going on, but we will focus mainly on the Fed and the European Central Bank policy decisions. Let's start with the one that happened yesterday on Wednesday. The Fed unanimously, and as we're looking at Euro USD on our screens, the Fed unanimously raised rates by 25 basis points as expected to 5.25%, and the highest since 2006. After, of course, having delivered 500 basis points worth of hikes since the March 2020 lift of a little over a year ago. Did not take more moves off the table, but removed the prior forward guidance of some policy firming may be appropriate reference. And this opened the door to a pause. In other words, the current level may well end up being the terminal rate. It's not a super explicit reference, but it's as explicit as it could be without spooking markets. If the Fed would have gone off and said, that's it, last hike today, that would have probably wreaked havoc to markets. But in any case, its last forecasts also point to this being the terminal rate. Markets agree with that, but go a step further and expect multiple rate cuts. But Chair Powell dismissed that, and that caused some reaction to markets. Overall, it was a balancing act, sustaining a hawkish bias because it focused on inflation still being too high and did not rule out further policy firming. But at the same time, it did offer a sign that the rate hike cycle has peaked. So that's it about the Fed. The ECB, again, on a different tune. The European Central Bank raised rates by 25 basis points, coming down from a series of outsized moves. This was in line with baseline projections, although there was talk of a bigger hike. Once again, no explicit forward guidance was provided, but hinted to further policy tightening, saying that future decisions, that's the policy statement, future decisions will ensure that rates will be brought to levels sufficiently restrictive in order to bring down inflation to the target, with the inflation outlook continuing to be too high for too long. And of course, right off the bat, Mrs. Lagarde, within the first Q&A, said that we are not pausing and we have more ground to cover. So again, a clear difference here between the two central banks in terms of tone and rhetoric. Now, Euro USD rose yesterday after the soft Fed, let's say the dovish, I would say, Fed, but failed to set fresh 22-23 highs, and knee-jerk reaction was lower today to the ECB. You can see here that it is in it's facing difficulties today. Outlook has not changed, technical and fundamental. There is risk of a breach of the 200-period DMA at around 1.093, but well protected after that. We have repeatedly talked about this region here, which both technically and fundamentally seems, I would say, strong with the data that we have now. Policy differential still favors the euro because the ECB did slow down its pace of tightening, but still clearly has more ground to cover, whereas the Fed hinted to the fact that it may have now reached the terminal rate, although no one can rule out further tightening. So bulls are still in control, especially as long as we stay above the black line, the 200-period DMA. They can set new highs, and but they will need fresh impetus for challenging 1.1233. That's pretty much it for Euro USD. Again, nothing has really changed on the outlook, but we need to remember that we still have more important data coming, mainly tomorrow's NFPs from the United States. We'll talk a little bit more about that at the end of our session, as always, with what we expect ahead. Now, I want to go to oil, which had quite a day yesterday in a negative way. Here it is. I have to say I was a bit surprised by the intensity of this this decline we've seen over the past several days. It slumped to new 2023 lows, but finds support. You can see that the RSI hit oversold levels, the most oversold levels in years. Now, why the drop? One thing is financial stress, because we talked about how regional, we're gonna talk a little bit more about that next, how regional banks remain pressured and there is still stress in the financial system. There are prospects of economic slowdown because of that and other factors. And the latest data from China were quite stellar. They do show that a sluggish recovery may be in play here. What stood out this week was factory activity, which contracted again after a series of expansions that contracted again as the manufacturing PMI fell back below the 50 line, the 50 mark in April. So it quickly reacted after that low, but now there is risk for a test of this region that we have highlighted in the past, 62.42, 61.72. But as we said, the move is stretched and the RSI is at the most oversold levels in years. Now, on the other hand, the likelihood that the Fed has hit terminal rate can help and allow for a rebound to the 73 region here. This is where we have the Ichimoku cloud, but further gains past the 200 period EMA at around 76.30 look tough at this stage. We will need significant catalyst here to see something like that. At this stage, risk is clearly on the downside, but again, we don't think it's really that possible to have sustained weakness past this highlighted green region here, given that even if in a sluggish manner, China is recovering and projections are still for a significant growth this year. There hasn't been a change in projections as seen by the IMF, for example. And prospects of a pause by the Fed can also be favor the US oil. And now let's go to the Nasdaq. We have here NAS 100. So what happened is it initially picked up yesterday as the Fed made this dovish shift to its statement, but then it dropped when Chair Powell ruled out cuts, which disappointed markets who expect multiple such cuts within the year. Today it's mixed. It closed yesterday negative. Today the index is mixed as prospects for a less aggressive Fed are capped by fears around regional banks. We have talked repeatedly about the whole SVB fallout, of course, but more recently about the First Republic Bank, which was acquired by JP Morgan eventually at the start of this week. But this acquisition has failed to mitigate concerns around regional banks. PacWest now is in focus and was losing around 40% in pre-market as it is looking for strategic options to raise funds. So definitely still fear here. This of course keeps risk for a slide towards the broader 2,500 region, again a region that we have highlighted. However, again, a strong catalyst would be needed for moves below this this level. On the other hand, bulls remain in control definitely as long as they are above the 200 period EMA, which had been tested a few days back, but held. And as long as they hold, they can set new 2023 highs, but significant improvement in sentiment will be needed for further gains towards and beyond 13,724. It's a tough outlook for uncertain actually outlook, I should say, for Wall Street at this stage because of these competing factors. They are definitely supported by hopes for rate cuts, but they have such hopes have been disappointed before. So it will be interesting to see how things play out. And now wrapping these things up, what we expect ahead is US jobs report on Friday. The labor market is extraordinarily tight. That's what Sir Powell said yesterday. Wages are elevated and job gains robust, even though there has been a slowdown in the pace of job creation, they're still robust. And unemployment at 3.5%, the last print, close to 5-decade lows. So that definitely puts the Fed into a restrictive stance. And we will wait for the new data on Friday. Other than that, we also have Apple reporting its earnings overnight at a difficult period as PC and smartphone shipments have struggled, not just for the company, for the industry as a whole. And obviously, if there is any forward guidance, that's also going to be in focus. So that is pretty much it for me. Just to reiterate that as we were conducting this webinar, President Lagarde of the ECB was still talking, so we still need to see what plays out there. Thank you. We will talk again next week on Tuesday, 10 minutes before Wall Street opens, as always.